Here's a question for you. What happens when a house of cards finally falls? Because that's exactly what we're looking at with today's global financial system. Cards have been stacking up for over decades, thanks to central banks pushing everyone, individuals, corporations, even governments, into taking more and more risk. And now we're about to see what happens when the entire structure starts to collapse. Let's talk about this. Okay, so I want to take a quick minute, share some thoughts. Now that we got the Fed cut, it really shows that there was some desperation behind the scenes. And so what comes next? So my personal opinion, the magnitude of risk will continue to escalate. So we're going to find out more about how this compounding debt will need to be paid off, restructured, or defaulted on. And unfortunately, this will not be pretty in of itself. So in this video here, I'm going to share with you some ideas into how all these levels of debt really impact the greater picture, which is ultimately falling down on the consumer and the average retail investor. Because all these corporations that are oversaturated in debt eventually will have to pass on the burden to the consumers, which means increased cost of goods and services and potentially more layoffs just to keep their doors open. So ultimately, this isn't something just for Wall Street insiders to worry about. It's something that affects you, whether you know it or not. So right now, there's a hidden danger lurking in your investments, your insurance policies, and even your bank accounts. It's called creditor-on-creditor violence. I know it sounds dramatic, but trust me, the financial games being played with your money are much more dangerous than you realize. So the first thing we're going to talk about is the bubble that no one wants to talk about. And so let's start with how we got here. So for years now, central banks have kept interest rates at or near zero. And what happens when interest rates are that low, you can't just park your money in a savings account and expect it to grow. So everyone, from individuals to massive corporations, were forced to take on more risk to get any kind of return. So it's like being told you have to drive faster to reach your destination, but the road ahead is covered in ice. It's a slippery slope. So what do you think happens when you push people to take on more risk? For over a decade now, you get a massive financial bubble, one that's starting to pop. And so the risk you didn't sign up for is what's about to be exposed. So here's where things get interesting. So when you lend money, whether through a 401k, insurance policy, or even indirectly through a mutual fund, you expect some level of protection, right? There are supposed to be rules in place to make sure you don't lose everything if things go south. So these rules are known as loan covenants, which are basically legal safeguards for investors. But guess what? Over the years, those protections have gotten weaker and weaker. In fact, they're now so flimsy that Moody's, the credit rating agency, says they're at historic lows. So translation, you're on your own if things blow up. But the real danger isn't just weak protections, it's that the financial players are now cannibalizing each other to stay afloat. And guess who's getting caught in the middle? You. This is what's known as a creditor-on-creditor violence, a scenario where one creditor, which is the new lender, takes advantage of another lender, which happens to be the old, shifting the risk onto unsuspecting investors. And so now we're going to have a domino effect that can't be avoided. And so you might be thinking, this sounds like a problem for big banks or hedge funds. So what does it have to do with me? So here's the reality. If you've got money in mutual funds, insurance companies, pension funds, or even just sitting in your bank, you're exposed. So let me break this down. When interest rates rise, the value of fixed rate debt, like the bonds your mutual funds or insurance company might hold, plummets. This means that all those safe investments are now worth a lot less. And while big financial institutions may be able to shuffle things around to hide the losses for a while, they're ultimately going to pass the pain on to you. It's like being in a game of musical chairs, and when the music stops, you're the one left without a seat. And don't be fooled into thinking that your insurance policy or retirement fund is bulletproof. The guarantees you think you have are only as good as a company's ability to pay. So if they go under, those promises go up in smoke. So this is called counterparty risk. The risk that a person or institution you're relying on to pay you back can't follow through. And right now, that risk is sky high. So there's a lot of sneaky moves that corporations are going to use to stay afloat. How are these companies managing to stay afloat if things are so bad? That's where they're playing dirty right now. And there are two moves in particular that you should know about. Number one, the drop-down maneuver. So imagine you lent money to a company and that company owned a bunch of valuable assets. You feel pretty safe, right? Well, not so fast. Companies have figured out a trick where they transfer their valuable assets to a new subsidiary, leaving the original company, the one you lent it to, with nothing but junk. So if things go bad, the original creditors, you, are left holding the bag. And the second one is called up-tiering. And so in this move, new lenders come in and bump themselves up the repayment list ahead of older creditors. That means that in the event of a bankruptcy, the new guys get paid first, and the original lenders, which again is you, are left with scraps. So it's like being at the buffet where you paid first, but new customers keep jumping in line and piling their plates first, leaving you with just crumbs. And so ultimately, the system is rigged against you. Now you might be wondering how this mess was allowed to happen. Didn't regulators or central banks see this coming? Oh yeah, they saw it coming all right. They just didn't do anything to stop it. So in fact, the whole system is set up to keep kicking the can further down the road as long as possible. And while that might work for a while, it only makes the eventual crash even more. So a good example would be Del Monte Foods. So everybody know the canned fruits. That company has been in everyone's pantry at some point throughout their entire lives. Even they're in trouble. Moody's recently downgraded them due to liquidity issues. And their solution, restructure their debt, which basically pushes older creditors to the back of the line. And this isn't just an isolated case. This is happening across the board. And so the question you should be wondering is, how do you protect yourself? So what can you do? So the solution isn't to trust that the financial system will magically fix itself. The system is built on a shaky foundation of debt. And when it collapses, you don't want to be standing nowhere near it. So the only way to truly protect yourself is to move outside the financial system. And by that, real tangible assets, and specifically physical gold, and more importantly, the most undervalued asset of all time, which is silver, not gold ETLs, paper gold, actual gold that you can hold in your hand. And why? Because gold and silver, the only financial asset that doesn't carry counterparty risk. There's no middleman, no contracts to read, no fine print that can leave you high and dry. Central banks and big financial institutions may downplay the importance of gold, but behind the scenes, they're stockpiling it. They know that when things go south, gold will hold its value. And so one thing is for sure, the clock is ticking. And the bottom line is, we're in the midst of a financial storm like no time in human history. And so most people don't even realize it yet. Creditor-on-creditor violence, weak loan covenants, and like upturn and drop downs are all signs that the system is cracking. So if you wait until the collapse hits front page news, it's already too late. So don't get caught without a seat when the music stops. Protect your wealth by moving into assets that can withstand the storms that are now present. And don't forget to build your local community. We're all going to need each other. And so just want to take a minute, share my thoughts in reference to some things that are worth paying attention to. The risk has just been magnified because of what we're witnessing now. The storm is upon us. Now it's a matter of letting the winds blow through, letting things sift through to see where we remain after all this stuff unfolds. And unfortunately, the government's response to what is brewing right now will be more currency creation. That is the only and the biggest thing that they can do is create more currency. And people who rely solely upon fiat currency to price and to value their current and future financial stability will be left holding the bag, literally, because that bag of currency will be similar to what's happening in Venezuela when you have currency scattered all throughout the streets. That is what they have used to prop this game up. But then again, things are unraveling. So you want to make sure you protect yourself by getting out of the old and into the new, or revisiting what has always been sound, true, and tested. Assets, precious metals. And then if you want to speculate with the crypto space, that's up to you as well. But anyway, if you guys are interested, mysilverteam.com is a way for you to get involved with actually being able to save, invest, and help others, and create a silver cycle where you can be your own bullion distributor. So if you're interested, links in the description. Other than that, leave a comment. Curious to hear your thoughts, and I'll catch you guys later.